On this week's Money Minutes with Seb, we're going to talk about a number that should be on every Canadian homeowner's radar. $2 trillion. That's roughly how much residential mortgage debt is sitting across this country right now, according to the Bank of Canada. And a huge chunk of it is about to hit a wall of higher interest rates. Now, before we get into it, I've spent more than 30 years in finance and business, and for a lot of that time, I've been working as a licensed mortgage broker. So when I talk about renewals and rate environments, this isn't theory. It's what I see day in and day out with real clients. That said, I'm not a financial advisor, and this isn't a substitute for sitting down with someone who knows your specific situation. If you want to talk it through, you can always reach out to me directly for us to look at your individual situation. So here's the thing about Canadian mortgages that trips a lot of people up. In the US, you can lock in a rate for 30 years and just not think about it. We don't have that luxury up here. Most of us renew every 3 to 5 years, and that means millions of Canadians who locked in rock bottom rates during the pandemic are now coming back to the table under completely different conditions. CMHC has flagged this renewal wave as a real risk to household finances. It's not happening all at once. It's spreading out over the next few years as terms come up one by one. And that's actually part of what makes it tricky. It's quiet. It's not one big headline moment. It's your neighbor renewing in March, then someone else in August, then you next spring. Same house, very different payment. Here's something else most people don't think about. Your fixed mortgage rate isn't just tied to what the Bank of Canada does. It's heavily influenced by government bond yields. So even if the Bank of Canada starts cutting its rate, fixed rates might not drop as fast as you'd expect. CMHC has pointed out that longer-term borrowing costs can stay elevated even after policy changes, which means relief, if it comes, might take longer to show up in your renewal offer than you'd hope. And look, we do have mortgage stress tests in this country, designed to make sure you could handle a higher payment before you ever got approved. That's a good thing. It protects the banking system. But a stress test on paper doesn't make your grocery bill or your car payment any smaller when your mortgage payment jumps. Families feel that difference in their actual monthly budget, not in a bank's risk model. If any of this sounds like it applies to you, hit that like button. It actually helps more people see this before their own renewal shows up. Now, why does this matter beyond your own household? Because when millions of people are going through the same thing at the same time, it stops being a personal budgeting issue and starts being an economic one. Here's what I mean. When households are putting more toward their mortgage, they typically pull back somewhere else. Less spending at local businesses, less flexibility for savings, less room to breathe. Multiply that across millions of homes, and a personal renewal date turns into something that shows up in the broader economy. The rules and the rate environment might be outside your control, but your prep work isn't. Knowing what's coming and talking to someone about your options early can help you feel more prepared, more confident, and better positioned to handle whatever your renewal looks like. Hit that subscribe button and the notification bell so you never miss a new Money Minutes. And if this helped you understand what's really going on with Canadian mortgages right now, share it with someone who's got a renewal coming up. That was your Money Minutes with Seb. Catch you next time.